Welcome everyone to a special Directed IRA webinar and Directed IRA podcast episode. Today I am joined by Chris Hanson from Hanson Capital, and we're going to be talking about why industrial beats multifamily. This was Chris's contention. We might debate it here for a minute. But Chris is an expert in this area. He's been investing in the real estate space since 2008. And I just want to give you a couple highlights on him so you know that he knows what he's talking about. I know a little bit about this. Chris knows more, so he'll be our subject matter expert. But Chris, I just had some background. I just want to give this, and I will let you introduce yourself and Hanson Capital. But back in 2008, Chris was in the single-family business and did 1,500 single-family properties in the real estate space. Moved to lending and did $500 million in private lending transactions in 2010 with about a $40 million portfolio.
Since 10.
What's that?
Since 2010.
Since 2010. Okay, all right. Still doing that?
Yeah, still.
But no single family anymore.
No single family today.
Okay.
Yeah.
Then in 2010, went to multifamily, and in 2018 went to industrial in California, Arizona, and Texas. Did I get that right?
Yeah, Utah, Nevada, Colorado.
Okay. All right.
Yeah.
Okay.
I can clean that up for sure.
Okay. Why don't you clean it up? I just
Yeah.
want people to know the progression of
Sure.
it.
Yeah.
Because I think it's important as we talk about why industrial, because there's
Yep.
a lot of different assets in real estate. So maybe tell us a bit more about you, clean it up,
Yeah.
and let's dig into industrial.
Matt, thanks for having me. Really appreciate it.
Yeah, you bet.
Yeah, I came out of mortgage banking in 2008 when the mortgage business slowed down fairly abruptly.
Yes, I remember that time.
I started buying foreclosures, which led to creating the auction service company, where
Okay.
I was buying on behalf of myself as well as others.
Yeah.
2010, we got licensed as mortgage bankers in the state of Arizona and added lending, hard money lending, private lending,
Okay.
private credit as a ancillary business to the real estate group.
Okay.
We started flipping. I was not good at flipping homes. Like, you know, the paint and carpet, hey, we'll
Yeah.
make it look pretty. That was not my expertise.
Okay.
I
Mine either.
I like buying apartment buildings. I could buy those. I could do a value add play, you know, paint, carpet, same effective thing, except it pays you every month instead of being empty, waiting to resell. We were very good at that. But through some life events, I was overworked and decided I wanted to look deeper into this triple net space.
Okay.
And that led to the first industrial investment in 2018.
Okay.
We still run industrial and multifamily investments. We built, most recently, we built a 128 home community in Dallas for rent.
Okay.
You know, like a 14-acre subdivision. So we're still very familiar with both asset types. But what I like to distinguish is a lot of people say, hey, this is what you should invest in. This is what I do. I say we've played with office, we've done retail development, we've kind of played with the main food groups.
Yeah.
Industrial works the best today.
Yeah.
That's why that's where we're investing.
Yeah.
It doesn't mean multifamily is no good. It means the underlying economics today say industrial is a smarter place for our money today.
Yeah, and I think when people hear of the asset class of real estate, well, the real estate market's, you know, challenging. Well, what piece of the real estate market? What geography too? But why is industrial? Maybe explain what industrial is for a second.
Yeah.
And then why is it better than some of these other areas in real estate, in your opinion?
Okay. Industrial real estate, a lot of people just drive by because it's a broad term. Like you could say residential, you know, as a sector of real estate, but there's mobile home parks.
Yeah.
There is freestanding homes. There's apartment buildings. There's towers in urban areas.
Yeah.
You know, it's broad.
Yep.
Industrial is the same. We have, you know, huge manufacturing facilities. We have distribution facilities. We have tiny last mile distribution centers. It's your trucking terminals. It's what the economy of the U.S. really runs on. All the goods and services generally have to flow through industrial products. So it's an essential component of our economy. And there have been some headlines about industrial being overbuilt, and I want to dig deeper into that. That's like saying residential is overbuilt. Well, yeah, maybe in this certain sector or that sector, but in general, the niche we're going after today being small bay multi-tenant industrial,
Okay.
which is like your neighborhood industrial parks. Think, you know, generally lower clear height buildings or shorter buildings that have maybe some retail frontage on one side of the building and a roll-up door in the back.
Yeah.
Where you've got, you know, maybe a paint or a flooring distributor,
Yeah.
you've got an HVAC contractor, that kind of stuff.
Yeah, this would be like my brother's business. You know, they do like they have a roofing business. you know, and
that's common tenant for us.
Yeah. Okay.
So that type of stuff needs proximity to rooftops.
Yeah.
They wouldn't be
That's
in
the type of building they're
Gilbert
exactly
to
in.
service Surprise.
Yeah.
Right. They'd want a shop near their customer
Okay.
base. So that kind of local service residential is our common tenant in what we call small bay multi-tenant. Multi-tenant just means instead of being a single tenant,
Yeah.
like a Starbucks or something, you've got a bunch of tenants.
Yeah.
The more tenants, the better. And that's
Yeah.
kind of our first parallel to apartments.
Okay. So I think another good way to think about this investment class, I'm always thinking about like, who is the tenant? Okay. So if we can get into like buying right and everything like that, but just
Yep.
think of like, who's the tenant? Well, in multifamily, I'm leasing to like families and individuals. Like this is their housing need.
Yep.
You know, in retail, my tenant could be a nail salon. It could be a small retail thing. I don't know, you know.
Yep.
But then when you get to industrial, who's the tenant here? We talked about this for a second, but when you're investing in that asset class, like you're kind of in the business that they're in. If their business
Yeah.
succeeds, you get paid. If their business isn't doing well or their industry, you're not getting paid.
Good point, and I've got an answer for it, fortunately
Yeah.
for me. So in your P&L or your operating expenses for any business, you're going to have a range of what percentage of your expense is your occupancy cost. You
Yeah.
know, for you on the law firm,
Yeah.
office could be a decent chunk. I don't know what percent
Yeah.
of your P&L it would be, but
Very
for
small
retail,
piece,
it could be up to like 60%
Yeah.
in certain cases.
Yeah.
In industrial, it averages between 3 and 5%
Yeah.
of their of their total P&L.
Makes
So
sense.
we're talking about a relatively insignificant or majorly insignificant component of their monthly overhead, depending on the uses. Some
Yeah.
of them would be different, but let's say that small business
Yeah.
owner, like you're talking about, the guy's got to pay his rent to stay in his apartment,
Yep.
although there's a lot of laws that make him be able to dance and play games to not pay rent as frequently.
Yeah.
His business doesn't get to exist if he doesn't pay rent on that building. So
Yeah.
it's
you can
the
lock
other
them
end
out.
of
You're
his
like,
essential.
you didn't pay, locked you out. Like,
Yeah, we have 5 days,
Yeah.
and we don't have the same landlord-tenant protections in the commercial sense. We work on leases that are a little more one-sided, you know, and I don't say that to be predatory, right?
Yeah.
But our commercial lease is designed to protect us as a landlord,
yeah.
whereas the residential leases are, you know, a lot more tenant-focused.
Yeah.
So from a legal standpoint, we just don't have the issues that I'm a multifamily landlord.
Yeah.
I'm in the weekly meetings. I know what our lawyers are spending their time on, and it's not our commercial tenants not paying. It's probably 10 or 20 to 1 residential tenants not paying and
Yeah.
having eviction issues compared to the industrial stuff.
Yeah.
So we're not seeing those issues, but you're right. It's generally smaller businesses, but our most recent acquisition, it was a $35 million deal, about $40 million with our total investment, the capital improvements and whatnot. It's 114 tenants in Houston at 343,000 feet, 28 acres across 21 buildings.
Wow.
So a whole industrial park ranging from like 1,500 square feet up to about 15,000. And that's kind of like a little small business incubator style
Totally, yeah.
property where tenants can grow and expand. They could even shrink if they need to.
Yeah.
And it should be running in the 93 to 96% occupied, very similar to multifamily. But you've got a less emotional customer because it's not the home where their children are sleeping. It's where they run their business, where their employees show up. So you don't have as much emotion tied to the transaction usually.
Yeah, and I like that first distinction you made too of like the percentage of their rent, you know, so, or like the percentage of their P&L that's
Yep.
going to that rent. That's totally true. Now they want to be cost conscious, right? And
Absolutely.
and you have to compete with other industrial spaces.
Yep.
So what does that competitive landscape look like right now to where you feel like I'm buying right now? Because you're not buying multifamily right now. I know you've bought multifamily,
Yep.
but you're not buying multifamily right
Correct.
now. So what's the competitiveness right now in this industrial space, and also does that affect the pricing?
So it's beyond competitive, and that is affecting pricing, and prices are going up. That building, I'll use that example for the December building before we get into the new deal. That we just opened a new deal last week that
Okay,
I know
yeah.
we'll cover later.
Yeah, that's
But
here in Arizona, right?
That's here in Arizona,
Okay,
yeah,
all right.
in Chandler. The pricing on these buildings is dictated by a few different factors. Being commercial, The income trickling into a cap rate is how we derive valuation.
Yeah.
A lot of these buildings, specifically the shallow bay multi-tenant, that's not a product type that we've been developing. So all the new inventory, the inventory of this product has grown by less than 2% over the last 5 years. That's at a national level. Whereas like 100,000 plus square foot buildings has grown over 25% just in the last 5 years. And that's because this is inherently a low density product. When you have drive lanes and aisles of these rows of buildings, it's not going to maximize lot coverage. So it's not going to maximize revenue potential. So it's not something that developers are chasing to go build, because you would build a bigger distribution center for one tenant if you were maximizing dollars on that site, right?
If you can get that tenant.
Sure, yeah.
Amazon's,
Correct.
We need a,
But with the rise in construction costs over the last few years, that math is penciling even less than it did before. So we've got this like supply constrained pocket of industrial, and now a lot of the institutions are showing up. Like as we just completed a 8 property transaction to a private equity group whose sole equity is JP Morgan. So we would effectively say we sold to JP Morgan's core fund by virtue of this conduit, right? Those guys just bought 8 properties from us, kind of validating true core institutional money chasing the asset type right now. That's led to rising prices, but rents are continuing to appreciate. So as opposed to multifamily today, we've got rents that are still rising, but my acquisition team has 6 guys scraping 12 different states, and it's like 23 markets across those 12 states. Like in Texas, we're in Dallas, Houston, and McAllen, kind of the southern border town. We're looking at somewhere between 700 to 1,000 properties a month, and we probably shoot out 25 to 30 offers, round numbers, and we might get an LOI done once a month, maybe every other month. We bought 4 buildings last year. So say round numbers, we looked at 10,000 to buy 4. That volume of looking at it is a differentiator, because with that footprint, we've got over 3,000 brokers that we're networked to that send us deals. It's not that I'm saying this is the product type, Matt, just go out and buy it. You got to buy the right one at the right price for it to be worth chasing.
And by the way, anyone listening right now live, of course, use the Q&A if you have questions. I'm going to pause here in about 10 minutes, and we'll take your questions for Chris. If you have some IRA questions, I'll field those too. But ideally, there'll be questions for Chris. So hang tight, or just throw them in the Q&A now, so you kind of, first in, first out. So get your questions in. Let me go back to those 4 that you did buy. Why were those 4 ones that you buy? And maybe we can use this case study on this one in Chandler right now of why are these ones compelling ones? You're looking at so much, and you end up transacting on these ones.
So we have 2 requirements for real estate for us to buy it. One is we want to buy below replacement cost. Probably the greatest lesson everybody should have learned from 2008 and the GFC is it doesn't work to pay double what you can build things for. That will hurt people.
Eventually supply will catch up.
Supply demand is the fundamental of real estate. And that's why we'll kind of trash multifamily, at least today, a little bit later. So we need to be buying below replacement cost. And the second one is we need to be buying below market rents. And it's just similar to that replacement cost theory, except I like to use Starbucks as the example. If you buy a 2,000 foot Starbucks and they're paying $70 a foot in rent and they leave, there's nobody else who's going to pay you that rent. It is irreplaceable. Therefore, you will lose money. Whereas if you buy that same 2,000 foot building and it's empty, you put Starbucks in there, well, now you've got this huge rent. It's valued by the rent. You're going to make a bunch of money. We will not buy something where the rents are above market, and it's just like in the apartment building. If we go buy a 100-unit building that the rents are 1,000 and they should be 1,500, well, we know we can raise our value 50% by doing that math. And if we go execute our value add play, that's how we force value creation. It's one thing to buy in the right market. It's another to be able to force or have a lever to extract that value. The below market rents is what gives us that leverage.
So let me stop there. So there's a couple criteria. One, you want to buy below replacement cost. So like this one in Chandler, I think I just saw some of your stuff you sent out on it. $120 a foot is what you're buying it for.
Correct.
And is that all in? Is that acquisition plus whatever improvements you need?
That's our purchase price on the asset.
Okay. What do you think it is per foot? Because you're going to throw some money into that deal?
Yeah, we're going to put 3.7 million as our CapEx budget on the building. So that's going to add a little under another $30 a foot. So we'll be all in. We're paying $119 for the building. We'll be all in the mid 140s.
Okay.
A little under 150.
Okay. And replacement on that would be, like if you had to build that same thing right now.
Round numbers, 240 construction costs.
Okay.
And that's ignoring the 2 years or so it would take you to plan, permit, and the interest carry on your capital requirement. So we're going to be somewhere in the 50 to 60% of replacement cost, all-in basis, which that's a basis that we love. We bought a building of the 4 we bought last year. We bought one just up the street in Tempe. It was fully vacant at our acquisition. We put it in contract in January of 25. It was a single tenant building just like this building. It had been developed as a 5-bay multi-tenant, but one tenant had expanded into the whole building. So we went in and demised it back into the 5 bays, taking it from a 45,000 foot single tenant that needed work into 5, 7 to 10,000 foot bays that was turnkey rate of lease. When we closed escrow at the start of August, we had 4 out of 5 bays leased. And today it's operating at 100% occupancy. So it's just over a year later, and we got that occupancy to 100 in January. So it took us 12 months to go from vacant to 100% leased by taking it from the less demanded product type, converting it to small bay multi-tenant, and leasing it up. And this building, it's 105,000 feet. We're going to convert it into 10 bays and run the exact same game plan. Now that building in Tempe, we paid $188 a foot for.
Okay.
So we're going to be in this one done with construction. And I think we put about $15 a foot. So we're just over 200 total basis in that one. We'll be under 150 on this one.
Okay.
Like that. That's why I'm excited about the deal.
Okay. So we've got, you're kind of building, you're really looking at this first on like, okay, the asset itself, am I buying it right, and the long-term supply and demand economics of this? Because is this inventory being built right now, like these smaller type bay industrial?
In a very limited
like you track
capacity.
the permits on that.
Correct.
And the markets.
That's what I was talking about, the supply side. So the growth of this specific product type being 25,000 or smaller bays, U.S. wide, grew less than 2% over the last 5 years.
Okay.
And we love to develop things. We're looking at it from a development standpoint, but if we were to go build something like this, we're looking at that $240 a foot. We're still going to have a 2-year development time. Then we would start a lease up.
Yeah.
So if we were starting from raw dirt today, we think that's a 3-year plan. In this case, we can have our renovations done somewhere in the 9-month range, and we think we're running a pretty conservative underwrite to say we'll have it fully stabilized within 2 years. So we'll be a whole year ahead, and we'll be 50% lower basis than a brand new product. And this building has brand new ACs, new roof. It'll be demised out well. So, I would always rather buy an existing product, bring it to market standard than go.
Is there any strategy, or I guess you might have multiple exit strategies on these? Like, what is your exit strategy on these? I know you've sold some already. You mentioned kind of private equity, the JP Morgan backed private equity fund. But is the end buyer on this later, you get these into multi-tenant?
Yep.
Is it going to be someone that wants to hold that as an investment as multi-tenant? Are you going to be like, well, once the supply and demand evens out, and now someone's got to pay $250 a foot to build this, I'm in on this one, $150. It could go back to single tenant. Like, how are you thinking about this when you're trying to exit?
So great questions there. I want to try and hit them in order. No, this building will not go back to single tenant. We're going to spend $4 million demising it, building different walls so that it's multiple suites. So you wouldn't take it back to single tenant.
Okay.
Our stabilized yield on this is just under an 8.6 cap.
Okay.
So that's virtually impossible to achieve. I can't go build new product and hit that kind of a yield. So I'm in the camp that I don't think our future is guaranteed upside. I'm kind of split 50-50. I could see some contraction with our economy. I could see some growth in our economy. I could see some inflationary signs. I do know I would love to hold assets that produce 8.5 caps. That's a number I like. So my plan is we're going to aggregate this, which is what we've done. I should back up. With our residential stuff, we aggregated those assets and sold them to institutions.
Okay.
With multifamily, aggregate units, institutional exit. Like that's the business plan. What we just proved was we sold 8 assets, 3 of which were syndicated deals before our first industrial fund, and then 5 were from our first industrial fund. That was the pool of these 8. There were 18 assets in our first industrial fund, which I'll point out was...
So, and that buyer wouldn't just buy one of those at a time. They want to, they need enough. It's not worth their time.
Yeah, that's the business plan. You aggregate enough of it so it's interesting. So this asset is along the same theme as the rest of these small bay buildings. So there's a whole bunch of exits. We could sell this asset individually because it's going to be a $25 million building when we're done. Institutional grade, multi-tenant building. We can sell that. One just sold nearby, or it's not sold, it's been awarded at $265 a foot. So we'd have a huge spread there upon stabilization. But our exit plan, because there's a sunset to our funds, is to roll these up and aggregate them, and then have either a recap to an institutional partner, allowing individual LPs to get off the bus if they want to, or if the money is good enough, we take it and we look for 1031 exchange options. Or if the market doesn't perform in the way we want to, we're happy to hold and maintain these 8.5 yields. Our other kind of internal rule is we'd love to see at least an 8 stabilized yield. That's a great number we're comfortable holding long run. So there's a lot of optionality with the exits here.
Okay.
And this is our third fund. It'll be the 4th asset in our third fund. We've got 28 buildings today, and a bunch of those thematically are along this small bay multi-tenant. There's a lot of institutional interest in that, but we've always kind of served the high net worth individual investor more so than the institution.
So, okay, you mentioned a fund. So are you, like this deal right now, one in Chandler, is that being syndicated? Is that part of the fund? How are you typically raising capital on your deals?
So we operate in a fund, but it runs as a series limited partnership.
Okay.
So every deal is its own series, and that series operates like a syndication. It has its own K1, but the fund structure, for this Fund 3 structure, allows us to recycle those securities docs without having to engage securities counsel on a new PPM and offering docs on every deal. Because what we learned is a lot of our customers, being high net worth, professionals or family offices, they will make an allocation to each subsequent deal we do. We just send a supplemental subscription agreement. They fill out the amount and they send it in, and then they get a K1 for every deal at the end of the year in their portal.
Okay, but that subscription agreement, if I'm investing, I'm in a specific series that owns one property.
Correct.
And so I can choose, well, that's the one I want to be in, and let's say this is one right now, and versus I'm in the fund at kind of the general level, the parent level, and I'm kind of participating in all these.
So we don't take money in that traditional sense of fund. Okay. I say fund because it's on our Fund 3, but each deal being syndicated, if you invest with us, you can invest today. We set up a queue. Like this deal is going to be about $17 million. There was a deal we actually canceled a few weeks ago, just that the due diligence wasn't coming in the way we wanted it to, and we're not scared to cancel deals because they don't pencil. I'd rather cancel the deal than not make money.
Yeah.
So if we have commitments, that makes our queue. It's kind of a first in, first out methodology. But your dollars will be allocated into a series, and you could say you're going to give us $500K, and I'd like to do $250 in this series and $250 in the next one.
Okay.
So we'll work with people on that.
Yeah.
But yes, it is identified assets. We take it blindly, but we don't mind, and we have a number of people who prefer to wait, see the deal, they want to go drive it, and say, yeah, all right, I'm interested, I'll participate in that one.
Got it. Okay. And you've had IRAs invest?
Yeah.
Okay,
yeah.
I know that's how we connected, and IRA was investing. We're like, we got to talk to these guys. They're here. Ted on your team, who we've worked with, was great. So, okay, let me pause here and see. Aaron's got some questions. Okay, Aaron, sorry, you've been hanging out over there.
Two quick ones to follow in that same vein. So, is this for accredited investors only?
Correct, yeah.
Okay, and then what is the minimums? Do you have?
Yeah, $50K minimum, check size.
Okay. Love that. And then what would you say, define small bay for those listening again, so they have, and what the kind of tenants are too.
Sure. So small bay is by definition, and it's pretty widely accepted, 25,000 or smaller square feet bay sizes. You'll go 0 to 25, 25 to 50, 50 to 100, 100 plus is usually the categories. There's also a million plus. There's just very little activity there. That's Amazon or other users generally make those. But small bay is 25,000 or smaller.
And these are those, I assume a lot of people have driven by these, right? They have the garage door maybe on the back side of it. There might be a little office up front or kind of like area. And that's what we're talking about here.
Correct.
And the tenants are going to be the contractors. I just met my brothers. That's the type of office they have this. They're in an industrial park and like some little office in the front and big bay in the back.
That one I mentioned in Tempe, the 5 tenants there, we have a aerospace company that does some light manufacturing. We have a plastics company that does like injection molding. We have a electrical contractor. We have a children's basketball camp. Like they built out some courts and stuff. So it's like that's kind of a neighborhood, for talented kids that want to be on club basketball teams type stuff.
Okay.
And one of I think it's the plastics group, ended up taking the second of the 5, or a second bay. So we have 4 total tenants across the 5 bays there today.
Perfect. That's a great example.
Can we hit on how an IRA can be involved, specifically a Roth, what that looks like, and then address, is UBIT come into play with this type of investment at all? Probably what UBIT is and if it is applicable. I had multiple people asking about this, which is kind of unique, but
it's in a number of questions.
Makes sense.
Yeah. So on the IRA, so obviously this is the Directed IRA webinar and podcast. So we wouldn't be talking about something if your IRA couldn't invest in it. So yes, IRAs can invest in all these types of real estate classes we talked about, including like Chris's fund, which is he'll have a fund, he'll have subscription documents, and they accept individual investors and IRAs, and we've had IRAs invest there before. And so this is like not an endorsement or anything like that, seek your own financial advice, yada yada. But we just like interesting investment ideas, right? And that's what we're trying to do, is talk about the things your IRA could invest in. And we haven't talked about industrial for a while, and so that's why we want to bring Chris in here as a subject matter expert. So yes, an IRA can invest, whether that's traditional or Roth. If your IRA is at Fidelity right now, by the way, it wouldn't be able to do this. You need a self-directed IRA custodian. That's what we do at Directed IRA. You open the account here, traditional IRA, Roth IRA. You could even self-direct your HSA. But we open the account here. We can transfer your money over, no tax, no penalty from Fidelity. And then you can invest in whatever you want. You want to be the duplex down the street. You want to do some private money lending out of it. You want to invest in a syndication or fund like we're talking about here. You think industrial is compelling. You want to do your due diligence whoever you're investing with. Look at their track record, understand them, someone like Chris. And then that capital gets deployed. So that's like on terms of, can your IRA invest in this? So, and let me answer the UBIT question. I presume you don't want to answer that one.
I can speak to it, but I'll let you run with it.
Okay, all right. I wrote a book on it, so I wanted to.
Then let's let you take
I wanted to take a shot at it. So
we could do part 1, part 2.
Yeah. So you have debt in the fund, I presume.
Correct.
Okay.
Yeah.
So what's the percentage of debt?
We usually run somewhere between 50 and 60% on an asset level.
Okay, 50 to 60%. Let's say it's...
And I want to say asset level rather than the fund, because we don't have debt at the fund level.
Okay. Yeah. So you buy this small bay industrial property. Let's say it's for $12 million. You might get a loan of $6 million on that. And you have $6 million of capital in it. You have some of your own money.
Yep.
You have your investors' money in there. Okay, so this tax called UBIT, the version most people are talking about in real estate is something called UDFI, unrelated debt financed income. And what UDFI is the government's basically said, hey, when your IRA goes and buys something, if there is debt leveraging that IRA's investment, you have to pay tax on the profits from the debt. So for example, when your IRA buys a mutual fund or you buy Apple stock, you got $100,000 in it, you can only buy $100,000 of an asset. But like, oh, you want to buy an small bay industrial property? let's just say you're buying it with your IRA directly for 1.2 million, and you put 600 grand in from your IRA. They're like, well, your IRA only had $600,000, but it bought a $1.2 million asset. So the IRS is like, that additional $600,000 of debt wasn't your IRA's money. It doesn't get the no tax treatment or the tax deferred treatment. You have to pay a tax called UBIT on that debt that's giving you greater purchasing power and a larger investment you would otherwise been able to make. And so in real estate, when you do this, you pay tax on the profits from the debt, whether your IRA is buying the real estate directly or you're investing in a fund that is leveraging with debt. Okay, so here, let's say it's 50% leverage with debt. Let's just run an example. Let's say you put in 100 grand, okay? And for anyone still listening on the podcast that's driving right now, you might want to pull over for a second. I don't want it to cause any accidents, but hear me out on this, okay? I want to answer this question, okay? Say you put in 100 grand and the deal's 50% leveraged with debt. Let's say you make 50,000. Oh, shoot, let me do a number I can do the math on. Let's say you make 40,000 in profit, okay? So you get 140 grand back. They sell the property, done. What's going to happen is you take that $40,000 gain and the IRS is like, well, half of that goes back to your IRA. Don't worry about taxes. The other half is subject to this tax called UBIT or UDFI, which you get capital gains rates on. So I will pay 20% on that 20 grand, which would be $4,000. So I made 40. I had to pay 4,000 in tax. My IRA got back 36 grand. Now, a lot of people are like, well, Matt, that sucks because my IRA isn't paying tax. Well, you know what? When your IRA owns a publicly traded company, they're C Corps, and those corporations are paying the corporate taxes on the profits. You're just not seeing it. It's eating into your return. So here, you just see the tax because it's coming in at the IRA level. Profits are being paid down to you wholly at no corporate tax on the real estate deal or at the fund or syndication level. And in that example there, making 36 grand and paying 4,000 is not that bad because I doubled the ability. I made twice the amount of investment I otherwise could have made. So that's why a lot of people will use their IRA and still leverage with debt into an investment, whether their IRA is buying real estate directly or it is going into a fund. And by the way, if that went over your head, there's a chapter in my book, The Self-Directed IRA Handbook, 3rd edition will be out here in a couple weeks. And also, we'll be talking about this at the Self-Directed IRA Summit, April 17th. We have 1,400 people registered for this. Okay, full day, all about self-directing your IRA, sdirasummit.com. If you have an account at Directed IRA, you get to come for free. So if you don't have an account, open one up and you can come for free. And make sure you're subscribed to our newsletter. You'll get updates on it as well. So that's sdirasummit.com. We'll have a whole section just going over this UBIT and UDFI. Anything you wanted to add to that?
Matt, I think you nailed it. I'll leave it to you.
All right. Okay. If anyone's still on,
a lot of people, almost 200.
I know. I'm just teasing, but
I do want to throw in, other than self-directed IRAs,
Yeah.
we also, and it's not common, we've got internal CPAs, internal legal counsel. So
Yeah.
we've kind of perfected a process. It's not rocket science to accept ticks.
Oh,
So
okay.
we will take 1031, which is not all that common. When we have a deal open, if somebody is selling something and they're trying to find a suitable exchange opportunity, we will take their 1031 money in as
like
a tenants in common, which
Okay.
gives a bunch of flexibility, even if that were to be in a self-directed IRA account.
A few
Okay.
people ask that actually. If
Yeah.
they can- yeah.
Yeah, so we take, we won't do it on less than a 500K check
Okay.
size because there's obviously some administration. It adds some complexity, but we've got a process worked out with our external tax advisors as well as our internal lawyers and CPAs, and we've run this through, a bunch of external customers with their own tax and legal advisors, and it's worked out great.
yeah, and the tick's great if you're selling real estate outside your IRA. You typically pay tax, but if you reinvest those proceeds, you have to do this 1031 exchange and follow the process. If you reinvest those within certain time periods, you don't pay any tax on the gains. That gain just rolls into the next property again. This is outside your IRA. But also, I'll say this too, that UDFI tax I just mentioned, when that property sells, you can do a 1031 on the UBIT or UDFI tax. So you can reinvest the proceeds when you're selling out of a property that had debt, let's say, where you can have this UDFI, UBIT tax, and reinvest it under the same 1031 rules, and you'll defer that gain as well. If you got to meet the timing rules to get into the next replacement property. All right, great questions though. What else we got?
Well, can we hit on how you're doing the the leasing? Are you using third-party management companies,
question.
brokers, company
So-
you own?
Yep. We have a management company. That's part of our vertical integration. We run our deals from sourcing and procurement through execution, operations, and disposition with every component except for the leasing. So we want to own our tenant relationship as soon as the lease is being signed. Because we operate as diversified geographically as we do, we want to use best-in-class local leasing in whatever market we're in. It also gives us the ability to fire them and hire a new one and mix it up from time to time as necessary. So they will do all of the tours, pending we have people on site, like that Houston building we bought in December. We have on-site staff, and our staff there works our other Houston assets. But every other component of that is internal. Third-party leasing is the piece that we outsource.
Great. Can you go through your 8% or you said 8.5% specifically cap rate? Does that translate to an 8% or 8.5% return to the investor? Can you walk through that?
Yeah.
There's some confusion.
Sure. So there's a website that maybe we can put in the comments here that will link to an opportunity page that summarizes the deal, and it'll summarize those returns. But no, the cap rate is just how we kind of compare one deal. You could use IRR from a total return standpoint, but a stabilized yield or cap rate is the income, the assets ticking off or just ticking off every year, like NOI, bottom line. The cash on cash distribution to the investor is going to be different. I don't know them off the top of my head because we have two different classes. We have an institutional class, which is $500K or greater, which includes an 8% preferred return. And then we have a retail class or investor class that does not have the pref. Those will both kick out a different cash on cash return, but on the website, I don't want to misspeak and misstate those numbers. I'll point them there. But generally, the distribution, the cash on cash is going to be greater because if we're putting debt on an asset, we should be getting a positive debt arbitrage, AKA if we can borrow the money for 6.5 and it's producing 8.5, we're going to make 2 points of arbitrage on the 50% debt that we put on the building in addition to the 8.5 on the unleveraged piece. But don't forget there's a waterfall, so we're taking a piece of the profits for operating the deal. So it's where that falls. It generally produces a better cash on cash than stabilized yield, though.
Yeah, but the cap rate is taking into account NOI and your acquisition.
Correct.
And so if you're putting debt on it and you're beating that, right?
Yeah.
Yes, the debt's not included in that. But also that's not including appreciation of the property.
Nope.
Either, which gives you return over time too. So you're making money on the cash flow ideally, right? And that's why a lot of people like real estate, no matter the categories. It could be industrial, commercial office, multifamily is.
Yep.
If you buy right and you've done it right, you're cash flowing the asset. And hopefully if you're buying at the right timing in the market, and the cycle of real estate is all real estate, industries have cycles. You're buying right, so you're going to get the upside appreciation over time. Let's talk about that for a second, actually. I'm interested in this. What is your perspective on where industrial will go versus other real estate asset classes in terms of that price you're going to be able to sell? Where do you feel like we're at in there? Is it flat?
That's a great question.
Are we at the bottom? Where are we?
So we have seen a pullback over the last few years because of the interest rate cycle.
Yeah.
So that has lifted cap rates up, and that's affecting sale prices, right? Cap rate goes up, sale price comes down. When we get cap rate compression, the sale prices are going up. So we think we've seen the value reset. Depending on which market we're talking about, we've seen values pull back, more in some than others. But industrial has pretty much steadily risen. It's gone flatter. But we haven't seen a huge pullback like we did in multifamily, and that comes down to the rents. So multifamily rents are still trending down nationally. That's why I don't think today's the time to buy. I don't want to be early. Industrial rents are still rising, and that comes back to our supply-demand imbalance. So if it's a product type that we can't easily replace, we feel pretty good about the supply side, and the markets we're focused on being kind of generally Sunbelt markets. We're seeing that migration population shift down here, and these assets service those rooftops. So we keep talking about we're short on housing in these areas of the country. Well, we need this real estate to service those houses.
Yeah.
So as we build more housing, we're going to need more of this real estate. It's already supply constrained, which is why the rents are still rising. So,
Okay.
you know, and it comes back to our philosophy in general. I'm targeting those high stabilized yields because I do have uncertainty on the future, but a lot of people got really comfortable over the last 10 years buying and doing value add, you know, not just multifamily, but other asset classes too, where they didn't expect the cash flow. They were making it all on the appreciation side.
Yeah.
I want to have cash flow to hold assets, and the appreciation is bonus. I mean, it's not bonus, we're underwriting for it, but if you're sitting there holding something that produces nothing, it's a lot harder to just go, well, one day when we sell it, we're going to make money. That's the uncertain piece. If we know with definitive, you know, market knowledge, we can get to a stabilized 8.5 yield, that produces cash we can distribute. So we can hold that. If market conditions improve drastically, we assemble these into a portfolio, sell them at a huge premium. Great, excellent exit. But if that second half doesn't come together, at least we're paying ourselves the whole time we own it.
Okay. So I just like the supply-demand imbalance here. I just think like it gives you so many opportunities to win right now when you can buy below replacement cost, right? That just means everybody that wants to now compete with you, they have to build new
Yeah.
at a higher cost.
Yep.
Meaning they're going to have to lease at a higher premium to make money, which gives you rent growth, presumably.
Gives me downside protection.
Yeah.
And that's what we're focused on. So it's a common phrase also in our industry to say risk-adjusted returns.
Yeah.
I came from a banking background. We're maybe a little pessimistic on business plans. It's conservative underwriting. But if I buy below replacement cost and I know I can raise rents, I have a hard time losing money.
Yeah.
Right? And I don't want to focus on the optimistic pro forma as much as I want to stress test it, run a conservative pro forma. How do we lose money in this situation where we're paying $119 a foot? I don't know. You know, anybody who says there's no risks is a liar, right? There's risks in the real estate business. But if you can buy at roughly half replacement cost and you can lease it up, I feel pretty good about that.
Yeah. Yeah.
So that's why we're focused, you know, laser focused on this particular niche today.
Okay. What about office? Let me just do that as a comparison, because that's another asset class where you can buy below replacement cost too. Why do you like industrial better than office? Even though I could maybe make that same play.
Yeah. So to be fair, we're looking at office. We have done office before. We've run value add on office. It's probably our least experienced asset class.
Okay.
I think there are some compelling opportunities there in the yields that we're seeing produced. And I would only look at, and I talk to brokers, and I'm very engaged with the top institutional capital markets guys in the country, and we're talking this stuff every day. You can buy A-class trophy assets in office that will yield somewhere between an 8 and a 10 today, maybe even a little higher depending on the market. At Main and Main, I really like that play. You know, some of the Biltmore Esplanade type assets, our office building at Scottsdale and Camelback, with the Portales building. I mean, there's some great assets that I think are on sale today. Yeah. Here's what gives me pause and why I'm not rushing into it, because we are underwriting it.
Yeah.
We're not scared to add another asset class. The actual operations of it are very similar to a small bay multi-tenant or an apartment building. But I am concerned with the growth in AI and what could be this collapse of this white collar workforce to some extent.
Yeah.
I mean, I have a remote hybrid staff to some extent. I think we have like 14 or 15 full-time in our Phoenix office out of 26 total. The rest, like our head of acquisitions sits in LA. We've got Texas staff. I am not convinced that we're going to get a return to office with the velocity that people say. And I heard an interesting theory that JP Morgan and Amazon and guys like that were mandating it. They already gave up a lot of their office space, but rather than have layoffs, which the market would not like, they demanded a return to office, which forced people to quit voluntarily.
Right. Yep.
So I am not as gung-ho on our ultimate demand side of the curve for office. That's what gives me pause. But I absolutely love buying a trophy asset at a 10 cap, borrowing debt at 6, and having a 4-point arbitrage. I think that makes sense. I I'm not as willing to go head on into that the way I am the industrial stuff, because I understand the full business cycle. I feel safer there today. But I like the office play.
Okay. So it goes back to, like, you're in the business your tenants are in. And I think those, the business the tenants are in your small bay industrial, need that office space, want that office space. There's stuff in that, not just people working typically too. Versus office, I mean, I think those professional organizations or companies that are in an office building, their business is probably going to be okay. I mean, they might need less people, which could decrease their footprint.
Exactly.
Or they have people working more remote. There's AI impacts, and so I can see there's more risk there.
And with office, there's some guys, and I don't think anybody's done it very successfully, although on Central here, we have somebody who's working on a nice one. The office to multifamily conversion is something that's challenging because of the floor plates usually. In our space, multifamily is at such high values. Guys are demoing these lower density industrial parks because it's worth more oftentimes as a multifamily site. Not in the last couple of years, but they were. So we have a shrinking supply side, very similar to what you see in office. But I think if you really go down every single bullet point side by side, I'm not opposed to it. But I know the managing directors of the office teams at the institutional level of CBRE, Colliers, JLL, all the big boys. And when we said, hey, we really want to look at this, I won't name names, but one of them told me just last week, he said, Hanson, there's absolutely deals here. I will tell you when they are. It's not going to be something you can do at scale like you do with industrial. It'll be a deal or two a year. And he's like, I'll let you know when I see one, and I'll write a check into it with you. That's how you'll know it's real. But it's not something you're going to be able to get done at scale. Now, that's a guy who's spent 25 years in office, knows it better than almost anybody in the country. He's on a national team. So take that for what it's worth.
Okay. All right. How are we doing on questions over there, Aaron?
I got two that would be good to cover right now. What's the historical ROI, minimum and maximum, for the projects you've completed? And then go into what's an exit like for the investor when they go into one of your syndications.
Okay. Let's clarify on the exit piece. Is that just timing or what happens?
I'd say both.
Okay.
Yeah, I'd hit both.
So every deal we do has a estimated timeline. Like the deal that's open now is listed as a 2-year execution on the opportunity page. When we have a sale, we will look and see if there's things that are compelling opportunities to exchange into. If there are, and it's part of our business plan, like our first fund, we just had this sale and we took those proceeds. They're sitting in an exchange account right now as we go look at things to redeploy into. That plan was buy kind of base level assets, which are sub-institutional, execute, sell them into institutional assets, which we would then assemble and go resell. So that's what we're doing. We're halfway through that plan. On this deal, the new deal, 2-year execution, I would plan to include that in this assembled portfolio with our exit in the next 2 to 4 years. That being said, the documents itself, as being part of the fund, has a sunset term, which is 8 years from when we opened it, and I think we opened it in December of 24. So it could go that far, and there's 2-year extensions for market conditions if we needed it. So generally, the things like that are like a 10-year fund life, but we're going to go solicit input. If everybody wants out, we're going to return cash, but we're going to let the deals dictate, hey, is there a good exchange opportunity? Because we're not going to compromise our buying criteria for the sake of exchanging. And we haven't even touched on it. I'm our single largest investor. That December deal was $17 million of equity raise. I put in 2.5 personally. I'm about 27% of our total AUM. So I am very vested in our interests. I'm not working for fees. I'm working to make carried interest and to succeed in the real estate. I'm making those decisions with discipline because myself and my team, our balance sheets are our business. What was the first question?
The historical ROI.
Okay. I couldn't speak at a firm level. I know it's north of a 20. This package of 8 that we just sold, that vintage was all bought between January of 20 and December of 21. arguably a horrible time to be buying commercial real estate, it produced a 24.9 cash on cash and just over a 4x multiple in a pretty insane time to produce that. That is not industry-wide since we started. That's this most recent transaction. I want to say it's low 20s IRR across our full track record.
Amazing. I know you spoke on this earlier, but if we could hit it again, just on how the investments are structured. Is it on one property or spread across all company-owned properties? If you could hit that one more time, that'd be great.
So with our third fund, our first series had a Texas asset and an Arizona asset. I had really smart people in both markets that said, I want to own in this one, but not that one. We were buying both. So since then, we've made a decision that we are going to do every single asset will be its own series, so we don't have to explain that. If it makes people uncomfortable to be split across geography, I don't want to force that. It's very little extra paperwork for me. So single asset, single series on everything we do going forward.
And I'll say one thing on that. I think for some of the people asking the question about what's the exit look like, I know sometimes you're trying to package these up to one buyer that's buying all of them, but sometimes you sell individual ones when the opportunity is right. And so rather than if you're in a fund with 10 properties, you got to wait till the 10th one sells, or they package all up. So it's possible there's an exit sooner.
Correct. Yeah.
Because you're just in that one syndication.
Exactly.
That syndicated series.
Yep. So we actually did people hate to revise fund docs after they're signed, right? Nobody likes that. Our first fund, we actually sent an amendment around to allow that. So if we sell a single asset out of a series, because our first series of our first fund had 5 deals in it. We don't want to sit on everybody's money until we wind the whole thing up. So yeah, we can sell a single asset and do a wind down of that single asset at an individual level.
All right, awesome. Well, I think we put a link in there about how to get in touch with Chris or his team if you have questions about them. Not meant to be an endorsement, of course. Do your own due diligence. But I think you see he has some great expertise in the industry and an interesting asset class we haven't talked about much here in the industrial space. Also, Self-Directed IRA Summit. Register if you have not registered. We want to see you there. If you did register, make sure you're on live. We're going to have some special things and downloadable resources you'll get if you're on live. You can learn more at sdirasummit.com. And Aaron was giving me some cues here. What else do I need to do?
To open an account.
Oh,
March.
Open a new
By
account
April 15th.
already.
Yeah.
All right. Maybe you can invest in a real estate deal, an industrial deal if you don't have you can buy crypto, invest in a venture deal, startup, small business. We don't care. Invest in what you love and believe in. Take control of your retirement. You can use the promo code MARCH200. Okay.
One of our best promos of the year.
It's our best, and we've carried it over into April, so you can take advantage of that. It saves you $200 opening a new account. So use MARCH200 when opening an account. Thanks, everyone, for being on. Thank you, Chris, for being our expert today. We'll see you next time. Until then, stay calm. Self-direct on.
It was good. And then